live event, and then also I'm going to segue you throughout the course of this presentation to our website and our resources you have available, so you can go and watch some of those videos. But we can use life insurance as a means to not only have life insurance protection, but to be able to grow an asset that can create a pension income for you in your later years at age 65, at age 66. So these are the tools. I use our products as the tools to be able to solve our clients' financial problems. So why is this so relevant and important to you? Well, guys, you already shine in the space. You already shine in the taxes space. So why not take the rapport and the interaction that you have with these clients and just simply say, hey, by the way, if you have questions about life insurance, if you have questions about retirement, I can help. Real easy segue. Now, I understand that some of you guys may not have a huge second season clientele. So if your primary business is first season clients, I mean, that's going to be mainly like term life insurance and products that are not very expensive. However, by starting to offer some of these services, you would be able to bring in some of those second season clients because we live in the Rio Grande Valley. We live in South Texas. This is primarily low income territory, clear across the board. The Rio Grande Valley, we're right next to the border. Um, and our clients are low income. Yet I'm able to find all of these clients with money. Why? Because now my business has become organic. And these clients with money, like the higher income clients, the ones that are making 75, 80, 90, 100,000, because I did such an amazing job retiring them, or because I did such an amazing job moving over their 401k, or I sat down and I created their social security portal. So now they have at least a basic idea of the amount of money that they're going to receive from social security. They're like, hey, do you do taxes? I said, well, I personally don't do taxes, but our company does. I said, can you guys take care of my taxes? I said, not a problem. And so I send over an email to one of our managers, and that's it. A new tax client, as easy as that. And these clients are so smart that they don't even come into the office. They just send us everything via email, and we just kind of start working on their taxes. And they just come in, yeah, once we're finalizing everything. But that's the true value proposition. The true value proposition here is not just the income that you're going to be able to make off of these products, which is substantial because, like I mentioned earlier, the margins are huge, but it's really the additional value that you can bring to your current clients and the clients that you're going to be able to bring to your business that are going to be more that second season clients, the clients that you can really build a brand on. Because you and I both know that our first season clients, those guys, like you wave something shiny in front of their face and they're going to go somewhere else because that's just the nature of the game. You know, if somebody else can give them an advance of $500 more, they don't care if you did a phenomenal job with their taxes. They're going to go somewhere else. So those clients come and go every single year. We still want those clients. Those are still great clients. Those clients still generate an amazing revenue for us, but we want more of those second season clients, the loyal clients, the ones that are going to show up when things calm down a little bit. Why? Because those are the clients that are going to stay on the books every single year, every single year. And those are the clients that really refer other clients of similar demographics. So why is this important, ladies and gentlemen? It's important because this is going to change the overall brand of your business. Now, for some of you guys, you may not want to do anything on the retirement space, but on the life insurance side, I mean, you sell 10 life insurance policies in a week, even if they're term, even if they're 20, $25 a month in premium, that's still going to create amazing revenue for you. So the purpose of these products is to find what works for you. If you already know from the get-go that you don't have a lot of those first season clients, it doesn't matter. We have products for them. If you have a lot of senior clients, we have products for them. If you are primarily second season clients, we definitely have products for them. So it's a matter of finding what fits in well with your current store or with your current business, but then also what direction do you want to head into? Are you wanting to pull in more of that second season clientele? Well, we have the products to start bringing those in. So let me talk to you a little bit about our products. Term life insurance, universal life insurance, final expense, and annuities. Term life insurance is just that. It's term life insurance. You buy a policy, you have coverage for, let's say, 10 years, 15 years, 20 years, whatever. I think we have term life insurance policies that go all the way up to 30 years. Term life insurance, really, we have two clienteles for that. We have the clients that are looking for some life insurance coverage for very minimal cost. So let's say, for example, we have a 35-year-old that comes in. Maybe they don't make a whole lot of money. They make $25,000 a year. They have 4 kids, so they're getting a pretty sizable tax return. And they want to make sure that in the event that they pass away, that their children are covered. But you already know from the get-go that they're not going to want to spend a lot of money. So you sell them a term life insurance policy if they're 35. A $200,000 term is probably going to come out to $25 a month, maybe $20 a month. If they're getting a $5,000 tax return, why not just pay the annual premium all at once? If they're doing $20 a month, just pay the whole premium and just be done with it. And then next year we can do the same thing. So that's one target market for term. The other target market for term is clients that maybe make a lot more money, but they're not trying to break the bank account by getting a $1 million permanent life insurance policy. So let's say, for example, same client, 35 years old. If we did a $1 million permanent life insurance policy, they may be paying $600-700 a month. They don't want to do that. So they want to do a $1 million policy because they make a lot of income and they're the only ones working, and they want to make sure if they pass away, they leave substantial income for their loved ones. Then we can do a $1 million term for 30 years. It'll come out to, let's say, $100 a month or $95 a month. See, so that's really the two ways that we utilize term. Another way that we've used term in the past is, let's say, clients that just bought a house, right? And they want to make sure that they have a life insurance policy to cover the balance of their home in the event that they passed away. Maybe they already have life insurance somewhere else, but they bought a $250,000 home. So we set them up with a $250,000 policy for 30 years. It's called mortgage protection, or that, at least that's the terminology used. It's basically just a term life insurance policy. And we use that term life insurance policy to be able to cover that balance on the home in the event that they were to pass away. So that's pretty much the term life insurance clients in a nutshell. Universal life insurance policies, they're a whole different animal. I will tell you from the get-go, I don't sell a lot of whole life insurance. I really live in the space of universal life insurance, and I'll explain to you why. Whole life insurance is a great product. I'm not saying it's a bad product, but whole life insurance I feel is a little bit more on the outdated side. With whole life insurance, if you buy it for the purpose of having permanent life insurance coverage and for the purpose of building that cash value, whole life insurance is going to live right around the 3% mark in terms of interest rate accumulation. We have universal life insurance policies, especially indexed universal life insurance policies that can make the client 9%, 10%, 11%, 12% interest on their cash value buildup. So because of that, I just always segue to universal life. It's very rare that I sell a whole life insurance policy because clients, they usually just want a permanent policy. And then if you can show them some cash value buildup, wonderful. And if you can show them some income out of that policy. So let's say, for example, if we do an index universal life insurance policy for somebody who's, let's say they're 37, and let's say they're going to do $150 a month, and they're going to fund that policy from age 37 to age 67 at $150 a month with the interest accumulation over time, they'd probably be able to pull $1,000 a month in income at age 67 in 30 years, which means in 30 years, we stop paying for the policy because we've built so much cash value in it. We stop paying for the policy in 30 years. We stop putting in the $150 a month. And now we start taking $1,000 a month in income out of that same policy. So we created a pension-like system within a life insurance policy. That's why I use universal life more so than whole life. But if you've used whole life before and you want us to talk about whole life in the future, I'd be more than happy to. I'll show you a kind of a side-by-side comparison, and then you can decide what you want to do as far as what you want to push in your store. But I like those universal life insurance policies because of that. And also I like universal life insurance policies because you can change the monthly premium. So the client doesn't have to stay at a fixed premium indefinitely for the rest of their lives. I have clients that set up universal life insurance policies, and we start at $150 a month, and maybe they go through a transition, and we bring that down to $100 a month, and then now they're making more money. Okay, now we can increase that to $175 a month. So we're able to really make adjustments as far as what they want to contribute on a monthly basis. As far as final expense life insurance, final expense life insurance is really life insurance for seniors, designed to do one thing and one thing only. It's designed to pay for their final expenses. So the target market here for final expense life insurance is people 50 and above. We have some very lenient companies as it pertains to final expense life insurance. So companies that let's say will pick up clients with a history of stroke, a history of heart attack, Parkinson's disease, um, diabetes with insulin. What's another one? Uh, Bypass surgery. So they're very lenient, but they're not intended to be very big policies. And so we use final expense as a way to outfit seniors that don't have any life insurance whatsoever. Why is it primarily for low income seniors? Well, it's primarily for low income seniors because um, if these seniors don't have any life insurance at age 67, it's probably because they just weren't aware enough or weren't in a financial situation where they could purchase a better policy when they were younger. So I'll use myself as an example. I have an index universal life insurance policy with a death benefit of about 290,000, which I contribute, I think, like $250 a month. So I'm using that policy twofold. I use it for the cash value buildup for the retirement, but I also use it for the coverage. That's a policy that's going to be with me for the rest of my life. So when I hit age 67, I don't have any need for final expense because I had the income and I was aware enough to make good decisions as it pertained to life insurance when I was younger. Most of the clients that fall into the final expense realm of products, uh, just generally they're low income clients. Not all the time, but most of the time. Other clients that may fall into this space is clients that are under the understanding that the life insurance from work is going to be with them forever, and then they retire and they realize that now they don't get the group rate, and now they try to convert and the price is just astronomical and they can't afford it. So at that point they have to go with something affordable, where the only thing that's going to be affordable is a $10,000 final expense life insurance. So you see there, it's really designed for the seniors, and it's really designed for the seniors that have some rather severe pre-existing conditions like the cancer, like the stroke, like the heart attack. For the other products like the term or the universal life, that's for clients that are either younger that can really put a good amount of money, or younger that are low income. Or it can also be for older clients that are looking for a substantial amount of coverage, as long as their health is good enough to get approved. So we can have a 60-year-old that is retired, but I mean, he worked for the government and he's getting a pension and he's getting Social Security and he's pulling money from his 401k. So he's bringing in like $9,000 a month and he's already retired, but he feels like he needs more life insurance. Well, we can sell him a universal life insurance as long as he doesn't have very severe pre-existing conditions. Maybe he has high blood pressure and cholesterol, and that's it. Then we can also sell universal life to older clients. Okay, so as we segue into outfitting your clients with potential products, that's my role here. My role is to help you figure out which direction we're going to go. Why? Because those are really the biggest questions that you're going to have initially. And so I circle back to what I was telling you earlier. A lot of the times people say, well, I don't want to start until I understand everything. Well, the problem is that you're not going to understand anything until we actually start interacting with clients. When we actually start interacting with clients is where you start to figure out, oh, okay, well, this client is young, doesn't make a lot of income. This is probably the best product for them. This client is older, doesn't have a lot of income, has a lot of pre-existing conditions. This is probably the best product for them. This client is a young professional making $100,000 a year. This is probably the best product for them. And we're really able to start tailoring to the needs of our clients. We have so many different carriers. I want to say we have probably very close to 100 different life insurance and annuity carriers. We don't use them all the time, but we have a lot of flexibility. And we have a lot of flexibility as it pertains to our competitors, because the State Farm guy down the street or the Allstate guy down the street, they're very limited on the amount of products that they can offer. We have no limitations. Why? Because we're, at the end of the day, we're independent agents, so we have the ability to contract with whoever we need to contract, and outfit our clients with the product that best fits their needs. And so now, to the next bullet point, which is annuities. Annuities is the space that we live in to move money over. And that money can be money that's coming from a pension plan. That money can be money that comes from a 401k. It can even be money that comes from the bank. Somebody has $50,000 sitting in the bank, not making anything. We can put it into an index annuity, and that index annuity, we can give them the guarantee that they're not going to lose any money and make a rate of return of 5 to 6%, as opposed to the 0.00027% that they would make in the bank. And so what an annuity is, and I'm going to let our partners at Synergy Financial, which they're going to talk about annuities in the next hour of this presentation, starting at about 1 o'clock. But annuities, they're a financial contract, a financial agreement between a client and a life insurance company, where we put funds into this agreement and they leave it in there for 5, 6, 7, 10 years. And because they're leaving the money in there for a certain amount of time, they're able to generate a rate of return every single year. Very similar to bonds. That's exactly the way bonds work. You put $50,000 in a bond and it's a 10-year bond. You leave it in there for 10 years, and the bond is going to make you 2% or 3% or 5%. Even though bonds are not making 5% right now, I think bonds right now like 1.5%. So we show them a product that works exactly the same, but they can make 6% or 7%. I guarantee you it's not going to be a hard sell. So it's just a matter of outfitting you with the right products. And within the realm of annuities is also where we can do the Roth IRAs, the traditional IRAs, the SEP IRAs. All of that falls under the realm of annuities, which is just a financial agreement with a life insurance company, which is why you don't need a securities license to do it. And as far as just being able to offer them good products with guarantees and a pretty good rate of return, I mean, there's really no downside there. It's just a matter of just presenting it to the client, and so a lot of the times the hesitation that we get here is, well, and let me talk to my financial advisor over at Edward Jones or Merrill Lynch or whatever, and they're welcome to do that. But most of those guys are not going to be able to sell them index annuities because they have so many restrictions as far as what they can or cannot sell. Well, we don't have those restrictions. So once they go over there and they say, can you show me something with zero risk that can generate me 5 to 6% a year? They're not going to have it because bonds can't do that right now. And really that's the only asset that they can sell them that would give them zero risk and a rate of return. So at that point, they're going to circle back to you and say, well, let's do this indexed annuity because it fits well within what I'm already doing. I need to have some money in the market, and I need to have some money in a more conservative space where I can get a pretty good rate of return over time. So once again, all of this stuff I can teach you as we progress forward. So what are our resources, guys? And we've been really working on this quite a bit for you because we want to make sure that you always have information at your fingertips. We've created a lot of video content. We have a digital quote card. We have our needs analysis. That's for the purpose of gathering client information. We have our weekly webinar. I help you with case design on a case by case. We have our agent website. We have quoting platforms, and we have our Freedom Insurance app, which I'm going to talk about in just a little bit. So what I'm going to do here is actually, I want to show you where you can get all of these resources, because we've been spending a lot of time on this. Now, this is something that we're still working on because we update this on a weekly basis. Can everybody see the Freedom Insurance website? Just want to make sure because I'm switching over before I go off talking. And I promise you guys, we're going to do a Q&A because I know you guys are going to have some questions. Wonderful. Perfect. This is our Freedom Insurance website, guys. All of the resources that you need are here, okay? Information, testimonials, whatever you need is here. But what I'm going to focus on right now is the training library, and the quote card. So we go over here to the training library. We're going to have some sales training videos for you. We've only uploaded a little bit of content on that, but the product training videos, which is here, this is the bread and butter of everything that we're talking about. Generating leads. You go through these, it'll take you 30 minutes to watch all of these videos. National Life Group. This is for term life insurance. Foresters. And we even have the application here. So after you watch the Foresters videos, we have a sample app and we have the actual application here. You click on that. And so you can actually download the actual application that you need to close this deal. So we're trying to make everything super user-friendly for you. Index Universal Life training videos, understanding annuity training videos. And so North American, it's an annuity company. Athene training videos are coming. F&G training videos. American Equity, this one's coming. And then we segue into final expense. What is final expense? Okay, so you get a much more thorough understanding of final expense life insurance than the one I gave you today. And then Mutual of Omaha, final expense company. Trinity, final expense company. Foresters, we use them for final expense as well. And then we have training videos on how to use the Freedom Insurance app and how you can quote on that. And then we have a cheat sheet to be able to find the right final expense product for your clients. So let me just go to this one real quick so that you guys can get excited about this stuff as I am. So this video, once you click on the video, you can actually go here.
Okay, ladies and gentlemen, the last thing that I want to cover with you is our cheat sheet.
And so through this, you'll be able to see how we can identify what companies will pick up a specific client, and this is for final expense primarily, a specific client basing it on their pre-existing conditions. So for example, a client had cancer. Okay, so you go to this, and actually this PDF, I believe is over here on forms. See, so this is the training, and we have over here forms. Here it is. So here's the PDF. So you can download this PDF and you can type in cancer, and it's going to tell you all the carriers that will accept clients with a pre-existing condition of cancer and what the look back is. So is it a 1 year look back? Is it a 2 year look back? A 3 year look back? So we can do that all through our website. And then we also have our quote card. So there's a training video on how to fill out the quote card. So the way this works is, let's say, for example, you're sitting with a client or you're making phone calls and you just want to get their information very, very quickly. You fill out the quote card. At the very end of the quote card, you put in your personal information, so name of agent, email, office location, and you hit submit, and this quote card is going to go to you so that you have all this information on your email, and it's also going to come to us so that at that point, we both have the information. So for the purpose of case design, let's say, for example, you have a client that had questions about a 401k, or maybe you had a client that wants life insurance, but they're on diabetes with insulin. Well, you have the information and we have the information, and now we can design something or find the right life insurance product or annuity product for this particular client. And the reason we designed this, guys, is because we know that you're busy, and we know that as you start interacting with clients, a lot of the times you're not going to have a lot of time. So you may not have the time to be able to work the deal right then and there, especially if you're new to the business and you don't know what you don't know. I mean, you don't know enough about life insurance or enough about annuities to be able to give them information right there on the spot, but you can take down this information. And so the conversation will go something like this. Mr. Jones, okay, we're about done here with your taxes. I want to let you know that we're offering life insurance. We're offering financial services. We can help you with your retirement questions, Social Security questions, 401ks, anything that you have uncertainties about, we can help. Mr. Jones says, so actually, I do have a question about an old 401k that's just been kind of sitting there, and it kind of goes up, goes down. I really don't know what I can do with that. Perfect. So what I'm going to do is I'm going to take down some information so that we can get together with you at a later time and we can break that down and see what we can do for you there. So you just jot down the information. You pretty much fill all of this out, which the video is right here. It explains exactly how to fill out the quote card. At the very end, you just hit submit. This goes to you, and a copy of this comes to us, and we are good to go. And we have the information. So then when things slow down, or maybe at the end of the day, you can send us an email and say, hey guys, I submitted a quote card with this client. When can we do a follow-up so we can see what we can do for them? At that point, we have all the information. So when we do the follow-up, say, okay, well, basing it on this information, let's run them an illustration with XYZ company for an accumulation annuity, or let's run them an illustration for lifetime income, or there's not enough information here. Let's see if we can set up a call with the client and gather some more information to see what they're wanting to do with the money. But you've already generated a lead for yourself that is trackable. You can track it and we can track it, and we can use this information to close this deal. So this is very important. So we have our quote card, our portal links are right here. So you can access all of the portals for all of the different companies. And pretty much everything's here. Our weekly webinars. We do a weekly webinar every Friday at 9:30, and they're all recorded, and we upload all of them here. Everything that you need as far as how to initiate your business on the life insurance and financial services side, it is all concentrated here on our website, because we want to make sure that everything is in one place. The quote card is here on the website. You can submit it directly from the website, and it really makes things a heck of a lot easier for you. Okay, so let me go back to the presentation so I can kind of get this wrapped up, and then we can turn it over to our partners over at Synergy. Perfect. Our Freedom Insurance app. We have the videos as far as how to utilize our Freedom Insurance app, and really what we use it for. It's mainly for term life insurance and for final expense life insurance. Those are really the two products that we quote on our Freedom Insurance app. We also do a very basic universal life, but it's very convenient because, let's say for example, you're at a gathering and somebody asks you about life insurance. You can literally, from the convenience of your phone, run them a quote on term life insurance. Or maybe you're sitting with your grandma, or I don't know, your grandma, aunt, uncle. You're at a family get together, and they're up there in age and they don't have any life insurance. You can run them a quote on final expense life insurance directly from your phone. So this is also built for convenience, and from the app itself, you can then send that quote either via text or via email. Okay, so convenience as much as we can. One of the things that agents ask me quite often is, do we do group benefits? We actually don't really focus on group benefits. Let me tell you why. Group benefits are very time consuming and can be very tedious. We do have the contracts. Like if you want to offer group benefits, we do have the contracts. But this is more like you having to go to a business and enroll everyone in group benefits. The margins are not very big, and it is a lot of work when you could very easily do the benefits outside of the group and really tailor it to the need of the client. And you can do that all from the convenience of your office. So I don't really see the need for you to have to go to a location to outfit people on group benefits when you already have so many tax clients that have questions that you can outfit from the convenience of your office. The issue with group benefits as well, as it pertains to employers, most of those benefits, when you leave, they get left behind because you get the group rate when you're there, but that group rate doesn't apply when you leave. So one of the probably most common rebuttals that I get from clients whenever we're talking about life insurance, like, well, I have life insurance to work. And I tell them, that's wonderful. Life insurance to work is great because it's so inexpensive. But the problem about life insurance to work is that when you leave, those benefits stay behind. So you need something outside of work so that whenever you retire or whenever you move to a different company, you can make sure that your life insurance policy is always there. Because what's going to happen is if the only life insurance policy you have is the one through work, and let's say it's for $100,000, sure, right now you're paying $10 a month. But when you retire and you try to make that a permanent policy, guess what? Oh, well, it's going to be $350 a month. Well, you can't afford that. So at that point, you just kind of let it go. Why not do that now where you can set up a policy outside of work for the same $100,000, pay $60 a month, $70 a month, have the cash value build up over time. And so now when you retire, not only do you still have the permanent life insurance, but then you have all of that cash value in there that you can utilize, or you can close the policy, take your cash value, or if it's an index universal life insurance policy, you can take income out of the policy. So just to give you clarity, we don't really focus on group benefits, but like I said, we have the contracts. If that's something that you feel would be a huge market for you, we can always circle back to that. How to contact us. Live sales at freedompolicy.com. When you email us at live sales, that email comes to me and it goes to my assistants, Therese and Grace. And so we are available for you all the time. You're also welcome to call us. We encourage you to join our Facebook group because our Facebook group is where we intend to put content on the daily. So every hour, every 5 hours, just make sure that we're always available for you there because it's a lot easier for us to communicate. And we want to make sure that you always have a way to access information, which is why we spend so much time putting so much content on our website, and which is why we spend so much time trying to make things as easy and as convenient as possible for you. Because I firmly believe that the hardest thing when you're trying to start something new is just the initial stages, the getting the ball rolling, the starting the new business or the new endeavor, because of that learning curve, because of the new skills that you need to develop to be able to make that happen. And so we're trying to make that as easy for you as possible. Okay, so before we segue into the full out annuity section, because annuities can get very complex very quickly, and before I introduce our partners, I want to see if you guys have any questions. As it pertains to what I've talked about in this first section, which this presentation, at least for me, was not with the intent of giving you a full understanding of the products, but more so how we use the products, why we use those products, why those products are important for you to have in your stores, and then show you the resources that we have available to you for you to be able to learn more about these products and for you to be able to contact us so we can help you with case design. But does anybody have any questions as of now? So let me see. Hold on real quick. Okay, so Jackie Nichols is saying if we have a workaround, if you need to write a company that you are not licensed with, yes. In the event that it's something that is extremely urgent, then we can work that case with you and we can submit it in-house through Freedom. But generally speaking, our contracting team has gotten so good at processing contracts that if you need something, we can generally get it to you very, very quickly, right? But in the event that it's something that's going to make or break the deal, then at that point, yeah, we'll troubleshoot that with you, not a problem. One of the things that we run into sometimes with some of our agents is they have some business that came up out of state and they don't have a license in that state. Sometimes that'll tend to delay the process, quite a bit, because you have to get a license in that state first. So in those situations, we'd be happy to work with you. That's a very good question, Jackie. Any other questions? Questions, comments, concerns? Good. All right, guys. So at least for the time being, because I'm still going to be on here, and we're still going to probably come back to me at some point, or for anything that our partners here need to reference me for. But I will tell you that the annuity space is something that's so valuable and something that can get very complex very, very quickly if you make it complex, that we really wanted to partner with an entity that had this space really well figured out and had this space pretty much down to a T. And that's our partners over at Synergy. And so that's Michael and Eric. And the beautiful thing about this partnership that we have with Synergy is that you can get a true non-biased recommendation and opinion, because our partners at Synergy work in the annuity space as it pertains to having a life insurance license, but they also work in the security space, manage money. They do that as well. And so this really allows us to be able to give the clients a non-biased opinion as it pertains to their finances, because a lot of the times if a client says, look, this is what I want to do, and an annuity is just not the right fit for that, and we say, you know what, then we have the partners to be able to do that. And the reason that's important for you guys is because, let's say, for example, you have a potential client that, I don't know, maybe they have $2 or $3 million in assets. It's like a big well, a big fish. And they're just so fixated on having the money in the market and having managed money, but they're 65. And we say, okay, we're going to go ahead and send you over to our partners in Synergy for this. And once they talk to Synergy, they realize that, hey, you know what, that indexed annuity does sound a hell of a lot better. If you would have sent that business somewhere else, guess what would have happened? Well, they probably would have sold them the indexed annuity, and that would have had nothing to do with you. But once we actually troubleshoot that, then that business can come back to us, and then now we all benefit from it. See, so having these resources available for us in-house is a huge, huge deal. I think I have one more question before. For customers who have insurance to work, can they have other insurance? Yes, of course. So for customers that have insurance to work, can they have insurance outside? Yes. Customers that have insurance to work can have as many life insurance policies outside of work as they would like. There's no limitation there. Obviously, we don't want them to have 3 or 4 or 5 different policies. A lot of the times, if a client comes to me and they have 3 or 4 policies, the first thing that I'm going to do is I'm going to review the policies that they already have and see if it might be better for them for us to take that premium that they're already paying and either do a replacement and take that premium and put them into a new policy. So that's all in case design. But yes, we can definitely do that. So that's a very good question. Anybody else before I turn this over? All right, let me see. Okay, well, so now, ladies and gentlemen, very excited to introduce you guys, our partners over at Synergy, and Mr. Eric and Michael. Guys, thank you so much for joining us today and taking the time to talk to our people.
Absolutely. Thanks.
All right, I'm going to turn it over to you guys now.
Perfect.
Just going to take control of the screen here real quick. Well, good afternoon, everyone. My name is Eric Estrada. I'm the annuity consultant here at Synergy. I work closely with Raul on making sure that he's identifying the best products, programs, conversation starters for the Liberty team to be leveraging. And I'm going to start today's presentation off, which we entitled Smart Tax Planning with Safe Money, by letting our founder and owner, Michael Schellinger, kick off today's conversation. So Michael, the floor is yours.
Awesome. Let's take a look a little bit about Synergy, and I won't go real deep in detail on this, but we are not only a consulting firm that helps out the Liberty enterprise here. We're a nationally recognized and award-winning insurance and retirement consulting firm with over 50 years of experience there. But we've got a flip side of the coin too, like Raul was kind of mentioning here, where we've actually got a practice that we've built that consists of sort of a dream team, if you will: fiduciaries, investment advisors, CFPs, RICPs, CLTCs, NSSAs, CHFCs, a lot of alphabet soup. And I'm not saying that to brag. I'm saying that in the fact that, what we realized over the course of 20 years or so is that you can't be all things to all people. You can't be all knowing and all knowledgeable, right? And you know what? Middle America tends to get hurt by the fact that they don't have enough wealth to have each one of these people on their advisory team. And at the end of the day, everybody needs these types of expertise. So first thing that we kind of take a look at with Synergy, is you have to kind of let go of this notion that one person has to know everything. From here going forward, I think you guys need to realize that you're different. You have a team back behind you. And I'll tell you what, I'm going to brag on Raul for a minute here. He is the best point man in the business. Not every single person knows what each one of these expertise and designations means. And quite frankly, a lot of clients don't know how to engage these type of specialties, if you will. Raul knows that. He is the person to go to in the beginning with the I got a guy or I got a gal, and he'll help filter out and know that, this person could use some expertise or could use somebody with this designation to look at this, right? So he knows how to engage, who to engage, and where to engage them, right? So my biggest advice to you as you watch this presentation is maybe not get so much into the nitty-gritty details on this, but keep this overwhelming view of that you don't have to let what you don't know stop you from helping people. Let me give you a very morbid and dramatic analogy, right? You're driving down the road, and it's just you and another car, and the other car is a mom and 3 kids, and all of a sudden that car flips over. You can see there's something drastically wrong with the people inside, and they're desperately trying to get out, and they're probably seriously injured. Is anybody on this call a doctor? Is anybody on this call a surgeon? Probably not, right? But would that stop you from trying to get in there and seeing what you can do? No, because even that call to 911 could end up saving somebody's life. So not to be that dramatic, but you know what? In Eagle School, we will, help you guys with a special process that will allow you to proactively engage anyone. So you don't have to know everything to help everybody, right? But what you do need to know and what you do need to pay attention to here is that you need to have the faith and confidence that the products and services that you're able to help quarterback are good for people. Eric, why don't you kind of take over and go to the next couple of slides and maybe dispel some myths that we constantly hear, and we'll kind of jump back into comparing and contrasting a little bit later.
Absolutely, Michael.
Just to clarify, guys, I only paid Michael a small sum of money.
Yeah. I didn't do my normal joke and ask if you paid me ahead of time. You know what I mean? But anyhow,
to say that I'm a good go-to guy. Just a little, not a lot.
Awesome. All right, everyone. Yeah, well, I'm sure everyone here has heard of annuities before. You've heard the good, you've heard the bad, you've heard the ugly, you've heard the Susie Ormans, you've heard the Dave Ramseys, you probably have someone's brother-in-law who may have snuffed a sale because they know someone who worked with the Ken Fisher rep. But after being in this business and one of our overall themes, we can tell you that every product has a place, no matter where it falls in the insurance or investment world, including annuities, as long as you can help identify the right product for the right client and create the right fit. So let's go ahead and get some of these annuity myths out of the way. You've probably heard things like annuities are bad. I'll tie my money up. The insurance company keeps my money if I pass. There's hidden fees. High comps come out of the high commissions come out of my own money. And the last one is annuities are a bad investment. Let's go ahead and go through these real quick and kind of demystify some of the myths. So annuities are bad. Guys, believe it or not, annuities have actually been around since ancient times. They go as far back as the time of the Roman soldiers. When Roman soldiers would pass, whether it be in battle or natural causes, their household, their wife and children would actually continue to receive a reduced portion of their income for as long as they needed it for the rest of their spouse's life, right? In the annuity world, we call those survivorship benefits to the spouse. Social Security is an annuity. It provides payments for life over one or two persons' life. So if you don't like annuities and you think they're bad, you must think Social Security is bad. Lottery payouts, those huge payouts that you see advertised on billboards, those aren't particularly lump sums. And some of you may have heard this before, but if a lottery winner takes the lump sum option, they usually get a lot less. They get a reduced amount. The way that they're able to maximize that full amount is they take that over a 10 or 20-year period until they receive their total payout. Again, that's an annuity. And employer pensions, which are coveted, but in reality, they're very much going extinct, are a version of an annuity. Now, one of my favorite things when it comes to advocating for annuities is I would Google these two professional baseball players with the word annuity after their name. Believe it or not, Babe Ruth actually made it through the Great Depression via annuities. His height of his career, of his baseball career, was during the Roaring 20s. He started the decade off as a young professional athlete would by spending a lot of money. It was a really good time. Well, about halfway through it, a friend of his convinced him to put some money into deferred annuities for a rainy day. What happened in 1929? We had the great stock market drop. And then 5 years later, he would be forced into retirement because of, he was a bigger guy and he put a lot of damage on his body. Babe Ruth then was able to turn on lifetime income payments. So regardless of the stock market drop, regardless if he was able to ever hit a home run ever again, he still had income coming in for as long as he needed it. Another one of my favorite stories is the Bobby Bonilla story. Bobby Bonilla played for the New York Mets. They owed him about $5.9 million on his original $30 million contract in the year 2000. What they did was they made him an offer that they thought that nobody would take. They said, hey, we don't have the money to pay you right now. We can't pay you all $0.59 million. But what if at some point in the future, we start paying you $1.2 million for the next 25 years? So starting in 2011, Bobby Bonilla started to collect $1.2 million. He'll get it all the way until the year 2035. And he took a debt owed to him of $5.9 million. By the time it's all said and done, he will have collected $30 million in money from the New York Mets, all via an annuity. So anyone who thinks annuities are bad, these are great stories to show them how they were able to save the day and put the client in a better position. I'll tie my money up. Again, not necessarily true. Most deferred annuities, meaning annuities that are sitting there earning interest to be used at a later date, typically have a 10% withdrawal feature. They can withdraw up to 10% of their account value without any penalty. That's a pretty standard option, kind of like seatbelts are on when you go buy a vehicle. It typically comes with it, right? There's also enhanced liquidity options where your client, depending on which annuity they end up with, could potentially pull more than 10% out of their annuity at a given time with no penalty. There's also return of premium features where your client can have peace of mind that at any time during the life of the contract, they can get their deposit back with no hassle, no penalty, no questions asked. And there's even what's called emergency exits. This is another pretty standard option on most fixed deferred annuities where in certain situations like the client's diagnosed as terminally ill, maybe they end up in a nursing home, maybe they need to start receiving home health care, they can get out of the contract with every dollar that they've earned up until that point, and there'll be no penalty. These are some hardships, if you will, that allow them to turn the annuity into 100% completely liquid. So to say that I'll tie my money up is not necessarily true. The insurance company keeps my money when I die. Again, not necessarily true. Now, if your client's receiving income, much like Social Security or pensions, we can actually have that income continue over the surviving spouse's life. That way, they're still receiving those hard-earned assets. Maybe they don't want income. Maybe they want to receive it in a lump sum. There's survivor benefits like the inherited IRA, where the client can pass on a lump sum to their spouse or to their kids with very minimal tax implications to them. But at the end of the day, what annuities allow us to do is add a design beneficiary to the contract. So that way, whether they're receiving income or they're waiting to use that money at a future date, if something happens to the annuitant or the owner of that contract, a member of their family, church, or charity will receive those benefits and the insurance company doesn't keep it. Hidden fees. Guys, there are no hidden fees in annuity. Any fee that's associated with an annuity will be 100% disclosed to your client. Now, annuities in their most basic fundamental form have no fees to the client. No fees to the client whatsoever. Every fixed deferred annuity typically will have is what we call a declining surrender schedule. So they get benefits, whether it be interest, whether it be income, in exchange for keeping their money with the insurance company for a promised amount of time. It could be 5 years, 7 years, 10 years. Again, it's up to the client and the advisor when they're selecting the right annuity for them, which penalty schedule is going to make the most sense. And that schedule starts off a little higher and goes down every single year that the client is involved until eventually it goes away and they're free and clear to do whatever they want with their deposit at the end of that schedule. Now, there are optional performance fees. These are kind of like a la carte options. And there's other guaranteed benefits that the client can elect as well. But again, these are 100% a la carte, and your client does not have to elect them, and they will 100% be disclosed. And speaking of disclosure, in every single annuity contract, it's going to include what we call the Statement of Understanding, or SOU for short. And those pages will specifically dial down to every single detail of that particular policy. They'll talk about the surrender schedule. They'll talk about the different options for growth. They'll talk about the different emergency exits. They'll talk about all the features available to your client in black and white, where they'll get a copy with their policy and you'll have a copy to keep as well. So not a single annuity can be issued without having this Statement of Understanding between the agent and the client signed and turned in with the application. High commissions come from my money. Again, another myth. Comps are actually paid from the house accounts of the insurance company. The insurance company has a huge room full of money that they need in order to keep policies on the books, and this is where they actually pay you from. 100% of your client's premium that's dedicated to earn interest is ready to earn interest from day one. It's not their premium minus the commission ready to earn interest. It's 100% of every dollar that they put into that policy. So commissions absolutely do not come from your client's deposit. And the last one, annuities are a bad investment. Well, that's actually true. They are. But when it comes to annuities, there's typically two conversations we're going to have: income versus interest. Now, income is one of the bigger reasons that they're purchased. We'll have a completely separate conversation and training about that when you get to Eagle School. Today's conversation is going to focus more around using annuities for interest, for earning interest. And this is where we can kind of muddy the waters a little bit when we try to lump some in annuities with what investments are. Now, again, we're typically going to have two flavors of annuities. We're going to have annuities designed for income, and this includes SPIAs, single premium immediate annuities. They put in a lump sum, a paycheck turns on almost right away for a set amount of time, for lifetime, for a certain amount of time, or maybe a combination of the two. You have deferred income annuities, very similar to the product that we just talked about, but the clients earmark that money to turn on to income, typically beyond a year. So if it's within a year, they'll use the immediate version. If it's beyond a year, they'll use the deferred version. And then, of course, you've got lifetime income benefit riders, guaranteed minimum withdrawal benefits, income riders, et cetera. These are all products designed for the income equation. What we want to focus on today are the deferred annuities or the growth annuities. Now we've got our traditional fixed rate annuities where every single year the client's committed to hold that policy. The insurance company will declare what the interest is for that year. If they want something a little bit more predictable, we've got our multi-year guaranteed options where every year that the client commits to keeping the policy with the company, they know exactly what their interest is going to be. For instance, they may commit to say, hey, if I go with this 5-year commitment to the company, they'll guarantee me 3% every single year. Again, it's a multi-year guaranteed annuity where every single year they know exactly what they're going to get. There's also fixed index annuities, which are the more popular of the deferred annuities, and we're going to dive into a little bit more of that here in a second. And there's also variable annuities, which I'll tell you right now, we do not offer at all. Everything that we offer is above this variable annuity line. They're fixed. Your client's money is never at risk. They're what we call safe money. Safe money, which very much has its place in your client's retirement plan. So here's what safe money is. Safe money is money your client can't afford to lose, meaning they're completely taking risk off the table. They don't want to gamble anyone. They want to make sure that no matter how much interest they earn going forward, 100% of their dollars deposited into the account is 100% protected. And secondly, they're seeking a reasonable rate of return, not getting rich overnight. If they can afford to lose money and they're looking to get rich overnight, that's very well an investment conversation. And again, investments, safe money, they've all got their place, but we never want to muddy the waters between the two. We want to keep safe money in the safe money conversation and investments in the investment conversation. And just to give you a little bit of a taste of the difference between safe money and investments, I'm going to have Michael come back on the line. He's an investment advisor to give you a taste of what it would take to actually chase returns on Wall Street and manage that yourself.
Thanks, Eric. I think one of the challenges that you'll find in middle America planning is that everything gets compared to that investment, but it's also one of those things where everybody wants safety. Part of my job a lot of times is to notice the difference between what you're saying and what you're doing. We call that a mismatch, and we call that an opportunity for education. So let's take a look at this next slide, and let's talk about what we call the real returns. You know what? When you're hearing water cooler talk and you're hearing people brag about their returns, so on and so forth, a lot of times people aren't realizing what they're saying is the nominal returns. So when you hear that quote and you hear the Dave Ramsey's, you hear the Sue Zorman say, the S&P has done this and that and the other kind of thing, and you hear those 11, 12, 13% numbers depending on what year we're in, that's a nominal return. Now, there's a couple things about that. There's no way you can get it. You have to be buying the exact thing that the S&P 500 is exchanging. You have to be on the floor. You have to make sure that you're hitting the right strike price at the right exact time. And you know what? These compounded numbers have this added element in there that you have to have all your money that you're ever going to need in advance in there with somebody doing everything for free at the exact right times and places, and you never touch it, you never move it, you are straight to the course, right? So even if you could get somebody to give you everything for free, which there's nothing free in life, people, you know what? It's impossible to get those nominal returns. Now, when we get to the real returns, you have expenses after paying somebody to do something. You have expenses and taxes after dividends, after capital gains if it's a non-qualified account. And you kind of boil things down to the real return. Thornburg does this every single year, and you kind of take away from this is a lot of times that real rate of return, what people actually get. And it has nothing to do with anything other than the fact that you can't quote a mathematical problem and get a real solution here. That real return, a lot of times it is about half of what you actually are looking at when you're starting to take it down from inflation numbers too. Let's take a look at this next slide and let's put that human element into it, just from an education standpoint. You know, a lot of times what we see in that, is it a good investment world, right? Well, I mean, you got to take the human factor into it. Money only does what people want it to do. And I don't know many people who aren't emotionally attached to their money. So Eric, let's transition through some of these bar graphs. And I'm not going to bore you guys with details. We can go into this more on Eagle School. But Dalbar does a study every single year, and they compare what that nominal return is to what people actually get. All right, the average investor out there chasing their investment themselves. And look at the far right-hand side over here. That gray bar is equity numbers. That red bar is bond numbers. That green, that dark green bar, that is what the investor gets because they're managing their own funds or they're actually reacting emotionally. And we'll go through that at Eagle School. I'll go through what I call the emotion commotion. Look at the difference there. Nominal return, 11.06. Average investor nominal return, 3.79. So you know what? Annuities aren't investments. You can only do three things with your money. You can spend it, you can save it, or you can invest it. And technically, the fourth thing is you can give it to somebody else to transfer a risk, right? Well, you know what? There's good and bad about investment, but it's hard pressed to show people that at the end of the day, you know, maybe as investing isn't everything that's cracked up to be. I say that to say this: everything's got a place in the portfolio. You know what? If you're going to build a car, investments are like building an engine. You know what? Nobody builds a car with just the biggest, beefiest engine out there and expects to take a road trip. You need seatbelts. You need airbags. You need steering wheels. Heck, you need brakes. You know, those are all safety features in there. So comparing annuities to investment, probably not the right thing to do, right? Middle America tends to do that. High net worth people don't. So that's one of those disparaging differences there. Eric, why don't you kind of go through a little bit of some of the hybrid nature of annuities where they weigh in different categories. They're not investments, but they're not like sticking your money underneath a mattress either.
So let's talk about earning interest via index annuities. This is that nice, happy medium, and it's so much simpler for your client to understand exactly how their interest is going to be earned when the market actually performs. So Michael quickly went through a little back office, a backstory on Wall Street. Now, while we know that's the place to get rich, so we also have the banks. Now, while we know that Wall Street's the place to get rich, we also know that your money's at risk and you could take a nasty fall with some bad timing. Now, the banks, they offer the safety net on our money, but even before coronavirus, if any of you guys have paid attention to any of the financial publications out there, interest rates were low and they're even lower now. I mean, the banks are paying almost nothing. So what indexing allows us to do is solve that what if. What if there was a middle ground where we could take the upside of the market with the safety of the banks? And that's exactly what index annuities do. Now, the interest your client earns on their policy is based on an outside index. We can use things that they're extremely familiar with, like the S&P 500 or the NASDAQ. I think there's probably 100 different indexes out there. If not, I'm probably underestimating out there.
No. Eric, there's actually more indexes out there than individual stocks by a long shot.
Oh, wow. Yeah. So I definitely undershot on that. And, you know, Michael, you know this too. There's even more proprietary index popping up all the time. Insurance companies are always coming up with new ways to calculate interest. They stay safe during your down year. So here's that safety net. Anytime the market goes down during your client's policy year, zero is going to be their hero. They won't earn anything, but they also won't lose anything. Now their policy credits every anniversary, which is typically every year, but there are policies that can credit on year 2 or 3. It just depends on which option they choose to earn their interest. So on policy anniversary, they'll get a statement. It'll show them how much interest they earned for the year based on the option they chose and the calculation associated with that. And then the next year, or after the first year, that next policy year, they'll be ready to earn interest all over again. Here's the other cool thing too. If there is a down year, the market does not have to recover from where it was before that down year for your client to earn interest. Wherever it's at the beginning of your client's next policy anniversary is their starting point. So even if it goes up over the next year after a loss, but doesn't make that loss up, your client would still see positive interest credited towards their account. And one of my favorite things about index annuities is they grow tax deferred. They have a feature that we call triple compounding. So that's interest on your premium, that's interest on your interest, and that's interest on the taxes that are still in the policy that you would have otherwise had to have paid out. So that's how we get the best of both worlds between the safety of the banks and capturing market upside via index annuities. Now, you might be wondering what kind of accounts can go into an annuity, whether it be a traditional annuity, a multi-year guaranteed, or a fixed index annuity. Well, we basically have 2 types of accounts out there with a bunch of different variations of these 2 types. We have before tax accounts, which we call qualified. These are the accounts where we might get a deduction today, but we're going to be paying taxes at some point in the future later on. These are typically our retirement accounts like IRAs, 401ks, 403bs, SEP IRAs, so on and so forth. And then you also have your after-tax accounts, which are your non-qualified accounts. These are accounts where the deposit taxes are paid beforehand when it goes in, and the only taxes that are due are taxes on any interest that your client may have earned along the way. But again, they won't have to pay taxes until they actually pull money out in either situation. So the money they would have been taxed on stays inside that policy and is continuing to earn interest as well. That's triple compounding. Now, here's a word. Michael talked about real rate of return. When it comes to safe money, I like the words reasonable rate of return. So we know we're not going to get rich, and we know we want to do better than what the banks offer. So let's talk about what those numbers look like potentially in a reasonable rate of return when we're looking for that happy middle ground between the 2. Now, if I wanted to go out and buy a 10-year annuity where I didn't have to think or guess or pick any indexing, I could probably go get a 3.2% guarantee every year for 10 years via a multi-year guaranteed annuity. So every year for 10 years, your client knows they would get 3.2%. So here's where index annuities fit. Not only do we want to do better than the banks, but we're also looking to just do a little bit better than what fixed rates are offering. So if 3.2 doesn't seem like enough interest for your client, but they're also not of that get rich mentality, they may want to consider an index annuity. So if you ask your client, over the next 10 years, what would be a number that you would be happy with as a reasonable rate of return? And they say something along the lines of like 3.21, just above that fixed rate to 5%. You're probably talking to a solid FIA candidate. They say something a little higher, like maybe 5 to 7%, then that's when we might want to consider some of these newer proprietary indexes, or like I mentioned earlier, maybe they look at an annuity where they can pay, a little bit of an a la carte feature to have higher room for growth and interest earned. Now, if they say anything higher than that, they're probably gamblers. They're probably still willing to take on risk, or maybe their expectations just aren't right. And maybe in an index annuity or a fixed annuity in general might not be the best fit for them. So again, reasonable rate of return. These aren't those huge numbers that you can get from the market, but they're numbers that are designed to do better than what the banks are paying and better than what the client could get by going with a multi-year guarantee from a fixed annuity. So here's a sample report from some of the competitive intelligence that we can pull to help identify the best products for advisors. I know Raul's a big fan of these. We talk about these all the time. And in this particular report, what I pulled is a list of all the best 10-year, 1-year crediting, meaning it'll credit interest every year, 1-year options on using the S&P 500. Now, using the best 25 options out of 188 options that are available out there on fixed index annuities today, you can see the top performing is about 4.56, all the way down to number 25, which is about 3.36. That's just above fixed rates in the low end, like we just talked about, and just under that 5% mark that I was talking about. This is a simple, clean, and easy look at what a fixed index annuity can do for your client. Here's a second report where, again, I'm no fees, 1 or 2 year options, but we're looking at some of these proprietary ones, these proprietary indexes outside of the S&P, outside of the NASDAQ. We're now look at the range. We have one that could potentially do up near the 8%-ish, down all the way to 5.42. So if you have a client that, again, they're not about the get rich attitude, but they may want to go a little faster, they maybe want a little more juice for the squeeze, and they still want safety along the way, well, that's when we'd go find the competitive intelligence to find some of the best proprietary strategies, or maybe they would be willing to consider something with a fee just to get a little bit more juice for the squeeze. But again, it's all about identifying the right fit for the right client with the right product. So who buys, who qualifies? So typically annuity prospects equally are men and women. It's about 50-50 on the split between men and women purchasing annuities. Now, we usually get them pre-retirement age, which is ages 50 to 64, but that doesn't mean that clients that are younger and even older can purchase annuities. In fact, we've sold annuities to clients that are in their high to mid 80s, even all the way up to age 90 if it's the right fit for them. They are typically married. And here's something that we're going to dive into on this next slide because it's so important. They're usually in what we call the retirement red zone. They have a household income of about 65,000 plus. They have 250,000 or more in assets. They are risk adverse. They are seeking safety. That is extremely important to them. And they've got that reasonable rate of return mindset over the getting rich mindset, which is the gamblers, the people willing to take on risk. There's also what we call suitability. Now, what this is it's financial underwriting that's submitted with every application that you turn into the company. Much like when you take a mortgage out on a property, the loan company doesn't want to make sure that you take on a bigger loan than you can actually handle. The same thing goes for annuities. The insurance companies want to make sure that we put the right amount of the client's overall portfolio into an annuity based on the benefits that they're seeking and making sure that they make sense. Now, the assets that we typically put in are liquid assets. The insurance company looks at their total liquid assets, and this is everything that's free and clear with no penalties, meaning there's no cost for them to move that asset into an annuity. There's absolutely no penalty whatsoever. It does not include the value of their home. This can include retirement assets. This can include investments. This includes money at the bank. Now, for clients that are 65 and older, typically the max we can put in is about 50% of their liquid assets. So if the client had $1 million in liquid assets, to keep it simple, the max that they can put into an annuity that made sense would be about $500,000. For clients that are under 65, we can get up to 75%. So again, for $1 million portfolio, they could get up to $750,000 potentially into fixed annuities. Sometimes we can get a little more. It just depends. It's case by case. If the strategy makes absolute sense and the client has some of these other things I'm going to talk about in play as well. They've got ample income. Can't be living check to check. There has to be some sort of surplus coming in. And they have at least 6 months of their expenses saved somewhere free and clear. So that way, if they do get in a pinch and they need some extra money, they've got a free and clear, no hassle spot with 6 months of expenses, sometimes maybe more, that they can draw from before they never need to touch the annuity. And the last thing that's really important to consider, and this is something that's newer in the last 10 years, is no reverse mortgages. Even if the client is not funding an annuity with a reverse mortgage, if they have one open, typically they won't get approved for the annuity. Now, I know I threw a lot of statistics and a lot of things as far as financial suitability, But one thing that I really want to focus on is stay big picture and really help identify when that client might be in the prime timing in their lifetime to have these conversations about safety, about preservation, about what's the best fit for them is the retirement red zone. And I want to let Michael dive in a little bit deeper to what the retirement red zone is and why it's so important that your client identify this time and make some key decisions that are important to the future of their retirement.
Thanks, Eric. If you guys are listening out there, you kept hearing Eric say, get rich, get rich, get rich, get rich. And I'll tell you what, everybody wants to get rich, right? But there comes a time and a place where that mind shifts. And at the end of the day, if you want to establish value, if you want to create a brand, if you want to help people get out of that transactional way of doing business with you, you need to be an overall consultant. And like I said before, your job isn't to know everything. It's to know enough to know where you can get in there and integrate and quarterback a team, if you will. So let's look at the stages of life and look at that retirement red zone, because that's where that whole get rich, if you will, that mind shift that happens. During your working years, there's thousands of books. There are people on TV every single day, Jim Cramer and Ramsey, Orman, they really focus on those working years. That is the sensationalist part of financial products, right? It's the action movies, if you will, of the world. And I can tell you the math during the working years, it doesn't matter as much. You're getting rich, that's discipline and savings over time, if you will. But there's something that happens as you start to go from the working years to the retirement years. Now, we call that the preservation years. And let's look at this next term right here that Eric's kind of already alluded to here. This is actually what we call the retirement red zone. Now, all those books and everything else like that focus on how to invest and, all these different theories, if you will, modern portfolio theory and everything else like that, depending on what your, what level your client's at, right? There are just as many studies coming out during these preservation years. And you know what? Every single one of them are pointing to the math and the science that shows that the 5 to 10 years before and the 5 to 10 years after retirement are the most crucial time to make sure you've got your ducks in a row. And I actually believe it's like 15 to 15 years after, right? So that'll tell you a couple of things. One, you can't just wake up one day and, hey, decided I'm retired and then shift what you're doing. And here's why. Let's take a look at this next slide. The number one fear of clients right now is running out of money before they run out of breath. And that's called longevity risk. Now, you know what? I have every now and again, somebody starts to, chime in with me and like, oh, the average age or, the life expectancy in America is actually dropping. Well, yes, it's dropping if you look at birth since zero because of this opioid epidemic or whatever kind of thing. That is half of the truth, right? Now, you may or may not be aware of this, and I'll show you in Eagle School how you can actually take a look and have a conversation with the client about longevity. But you have a different set of life expectancy for each age that you attain. So a person who is turning 65 today has a different set of life expectancies from a baby that was born. Interestingly, the first person who will live to 120 years, scientists say that they've already been born. So let's put up the next thing right there. And let's look at a life expectancy for people who are both 65 right now. There's a 50% chance that one of the two of them will make it to age 93. And the next thing will show you that there is a 25% chance that one of the two of them will make it to 98. Now, this is a 2012 study. These numbers have gone up. They usually do them about every 10 years. I kind of think that this next couple of years when it comes out, you're going to see that 93 change to 95, and you're going to see that 98 changed to about 101, 102. We see that in the life insurance products that we take a look at today too. So that means people are living 30 years or more in retirement. They've got a good possibility of making it that far. And as a whole, pensions have gone away. So that retirement red zone comes into a huge play. And let's look at the next slide and why. Now, Don't get overwhelmed by this. I'm going to go through it kind of, high level, but I'll show you in Eagle School a better narrative. It takes a little longer, but I'll show you a better narrative to illustrate why it matters when you retire. None of us have a crystal ball, right? So at the end of the day, one of the things that matters more in retirement is your starting point sensitivity. So this is a study that Legg Mason does every year. And they just take, pretend that somebody had the exact same portfolio and they just have time machines, right? They retired at 1926, 1928, 1930. And they look at every 30-year segment and say, hey, would their money last 30 years? So as we see on the next little segment here, the green lines are going to show you every time that their income lasted more than 30 years. If you retired at 65 and you made it to 95, hey, you didn't run out of money before you ran out of breath, right? Now, these next red segments are going to show you every time they ran out of money before they ran out of breath. What's the difference? Simply starting point sensitivity and having a fully invested portfolio in some kind of market-based volatility, right? The next 2 or 3 lines here are just kind of a little bit nerdy stuff, if you will. It'll show you your chances of running out by 75, by 85, by 95. It all depends on your client. I could tell you when we do this is called Monte Carloing. What it does is give you probability statistics, but imagine I gave you this scenario. We all need to take a trip on a plane. There are 10 planes on the tarmac. And I say that, you know what, it's guaranteed that one of these planes are going to go down. I don't know which one's going to be, but go ahead. You got a 90% chance that you're going to pick the right plane. Go ahead and get on a plane. I don't know a single soul who's going to take me up on that offer and go and sit in the seat and buckle their seatbelt and wait to see if they picked right. You know what I mean? So it's real important to see what statistics mean versus what real life means. Let me give you a couple of examples to show you how math completely works different in retirement. Let's move on to the next slide. The number one fear of retirees is making sure that they have money to last their lifetime. You know what? On that list of things, volatility is like the 7th or 8th fear, but they're cousins. You know what I mean? One thing impacts another. So I don't have the ability to do it like I would do in a presentation here or, on a group setting and what have you kind of thing. But we're gonna do a little quiz. Pretend I gave you $100,000. Let me stop real quick. I'm not going to give you $100,000, but pretend I did. Which of these 2 series of gains or losses would you want to have at the end of 5 years? Scenario A or scenario B? Now, scenario A has a 15 up, 7 up, 10 up. We went back a little bit, 12 down, and then 12 up. Whereas scenario B, plain Jane, boring, 6% all the way through, right? So when you do this with the client, I don't care what type of licensing you have or anything else like that. This is math, all right? Everybody can talk about this. So I will tell you that most people sit there and hem and haw, and they don't have the calculation. So I'll offer everybody on this too. I'll give you a hint. Let's go ahead and see what the hint is. All right. Well, you know what? The average rate of return in scenario A was 6.4. The average rate of return in scenario B is 6. So which one would you rather have? Most people will sit there and tell you scenario A, obviously, right? But let's look at what volatility actually does to money. At the end of the day, the reality is scenario B produces more result than scenario A. Now, why is that? It's because people don't understand the dynamics of volatility. Let's look at the next chart real quick. And this is actually a sit-down piece that you can use with people. One of our companies provides this, if you will. It's the mathematics of volatility. People don't understand. And you know what? It's not that people are dumb or this, that, and the other kind of stuff. It's just math is not. It's just not it's not intuitive, right? If you lost 50% of your portfolio, something similar to what happened in 2008, you don't need 50% to get back to even. You need 100% to get back to even. If you ask that question in reverse, 99% of people, it's like, hey, listen, if you lost 50%, what do you need next year to get back to even? And people are like, oh, no, you need 50% gain. No. If I gave you $100 and I took $50 away and I said, you know what, I'll give you 50% of what you got in your hand back, you have $75 left in your hand. 25% just disappeared, $25. So people don't understand the mathematics of volatility. That's incredibly important to that red zone. It's incredibly important to, retirement income planning. And that's where the annuities fit into that picture, because you can't be all engine. You can't have your foot on the rev all the time. Let's look at the next one, and I'll give you, I'll give you a simpler math question you can go through. Let's talk about average rate of returns, because let's say, people are actually trying to figure out, it always makes sense. If you're not testing, you're guessing, right? So if you're seeing if you're going to run out of money before you run out of breath, people always use averages. And you know what? Let's take a look at what that does. So if I said, listen, if you had an average 20% return for 2 years, how much will you have? Eric, let's pull up the choices here. Now, on your piece of paper, you're there. Tell me which of these are right. A, at 1440, B, at 1280, C, at $800, or D, at 0. If you're writing down on your paper, I can pretty much will guess what you're saying, right? But let's take a look at what really averages come down to be. If we look at the verbiage that's going to follow this right now, you'll see that A is definitely right? If you had $1,000, and you had 20% return for the next 2 years, 20 times 20 there, that's 1440, and you know what, that average is at 20%, right? What about B? You know what, B is right also. If you had 60% gain the first year and 20% loss the second year, hey, that arithmetic mean, that average is actually 20. It's 60 minus 20 is 40 divided by 2, that's 20. But the dollar amount's different, isn't it? C, also correct, right? You've got 100% gain the first year and 60% loss the second. Average is still 20, $800 in your account. D, we see this in commodities trading, right? 140% gain, 100% loss. Obviously, 140 minus 100 is 20, but at the end of the day, big old fat goose egg on D. So as you start having that conversation, maybe it's not so much get rich versus not get rich, right? That's a mentality shift, if you will. It's maybe a little bit more of you don't know what you don't know. And as you start to get towards that retirement red zone, can you afford to undo all the good you have done up until now? Quite frankly, middle America has a problem with that. They compare everything to an investment, and they sit at the blackjack table longer than they think they should. But they're also the people that tell you, I can't afford to lose these things. High net worth people, every dollar has a purpose for later in life, if you will. So Eric, well, let's go through a couple maybe samples of people just so we can take a look at maybe where some of these things fit in. And remember, we're doing this all just to kind of give you some education. But at the end of the day, it's as simple as this. Having a conversation with somebody, and we'll make sure that we've got narratives, and I'll give you that proactive way to do this in Eagle School, and then calling up Raul and say, hey, listen, I got somebody who said this, that, or the other. Let's take a look.
Perfect. Thanks, Michael. So now that we've identified what the retirement red zone is, here's some of the people that I'm sure have come into your office. They may have said some of the things that we're going to go through today. And these are the conversations that you're going to have with them during that critical time of just before and just after their ideal retirement age. So let's look at case study 1. Let's talk about Mr. Too Conservative and didn't realize it. Now, there are $17 trillion sitting on the sidelines. What that means is that there are $17 trillion in what we call lazy money, dead money, or simply bank money. There is $17 trillion earning less than 1% right now. This is a great opportunity for you to have a conversation with your client about perhaps using some of that money into a fixed rate alternative like a fixed annuity. So you have your clients that are over allocated to cash. Now, I mentioned during suitability that as far as a financially sound application, the insurance company is going to want to make sure they have at least 6 months of their expenses somewhere free and clear, and a bank account, money market account, savings account. Those are completely great homes to stick that somewhere. Sure, they're not earning much, but those are those emergency monies. Liquidity is of the most importance. But anything beyond that, there's no reason that they should be earning less than 1%. So as you get to know your clients, or you're going through a client statement or their tax return, you see, wow, you've got a lot of money at the bank, well beyond 6 months of expenses. It may be worth having a conversation where you explore a fixed annuity as a low interest rate alternative. So that's that client that's over allocated to cash. Now here's another kind of client that we see from a conservative perspective. It's all too familiar, and that's clients with those low yielding taxable CDs. Now we don't see as many people taking these out from the first time as we do people that have inherited them. Back in the day, their parents, their grandparents, they would go to the bank and they would get a toaster or something like that for open up a CD. They never use it. And what happens? It ends up getting passed down to the kid. So not only are these CD certificates of deposit low yielding, in fact, I think I checked just the other day, and a 5-year note is 5-year commitment is somewhere around like 1.8%. Again, we know that we can do much better than that. And even the predictable world of fixed annuities and CDs are taxable every year that your client earns interest. So the solutions, it may be worth having a conversation if you have a client that's over allocated to cash or is still holding on to a low yielding taxable CD about multi-year guaranteed annuities. In fact, those have a nickname in our side of the industry, what we call CD busters. They look like a CD, they smell like a CD, they walk like a CD, but they're not a CD because they provide more interest, usually 200 to 300% more than what the banks are offering, and they do it tax deferred. We can also look at perhaps short-term fixed index annuity. There are index annuities that go down to as low as 7-year commitments and even 5-year commitments, very similar to a 60-month CD. And again, those are both tax deferred regardless of which flavor your client ends up using. Now, what I would also probe that you do is ask, what's the money for? Why is there so much in the bank right now? Is it extra cash for an emergency? Do you plan on leaving it behind and just didn't know what to do with it? Do you plan on living on it in the future because you think things will get more expensive? Either way, dig just a little bit deeper, because there may be an opportunity for another style of annuity, or maybe an income planning cell, or a lot of other different types of safe money solutions that we can put on the table when you dig just a little bit deeper and get that information in our role, so we can start quarterbacking that process. So that's case study 1. That's Mr. Conservative and didn't realize it. That's that $17 trillion sitting at the banks that your client doesn't need to have more than 6 months of expenses of for rainy day purposes. And definitely don't need to be holding on to taxable CDs. Now here's case study number 2. This is Mr. Too Risky and in the red zone. And as Michael just went through, it is imperative to have conversations about preservation, about guarantees, about protection, because otherwise you could get further into retirement and create problems that you can't undo. So there are clients that are over allocated to risk and in the red zone. Now, like Michael said, they're still at the blackjack table and 100% of their funds are on that table. Now, there's an old rule of thumb when it comes to how much should be at risk and how much should not be at risk, and that's called the rule of 100. And typically what it was is whatever your age is, that's the percent of your assets that should not be at risk. Now, that very much has a lot of wiggle room in modern planning, because there's all different types of elements to consider, all different types of retirement goals and concerns to consider. But at the end of the day, the overall theme is the same. The older you get, the closer you get to retirement, especially when you're in the red zone, you should be looking at what percent of your assets make sense to not have at risk anymore. That way, you don't create problems that you can't undo. So we can look at existing accounts that were in the market and just took a hit. I'm sure we all can tell you have that client that you may have met with at some point. And they say, no, I'm good. I'm going to keep riding the wave. And then they take a hit from a market drop. They come back to you hand in hand and say, okay, tell me about that safe product again. And these can be those IRAs, 403Bs, Roths, variable annuities, mutual funds, managed money stocks, anything still at risk and in the market. When this does happen, I recommend you get that statement on the account and get it to the team, get it to our role. That way we can start going through it, looking at the particulars and figuring out how it may compare versus what an annuity can do for them. The reasonable rate of return expectations are within the FI range, and they're seeking safety. They're saying, Mr. Franchise owner, I took a hit. Man, I know I'm probably not going to see the returns that I got during my working years, but that's fine. Anything that's better than the banks, anything that's better than these low yielding products that I've been hearing about. And I can't afford to take any more risks. That's someone that we want to have a conversation about preservation and asset protection. And from a smart tax planning perspective, we can transfer both these IRA 403b accounts, or these non-qualified accounts, these AUM, these stocks, all different types, into an annuity via transfer or 1035 exchange without any tax implications for moving that money into an annuity. And the solutions typically are, we're looking for a 7 or maybe a 10-year FIA, maybe something shorter, maybe something longer. Again, dig a little bit deeper to see if accumulated money is still even a main concern of theirs. So that's the Mr. Too risky and in the red zone. It's time to start talking preservation, especially if they've taken a hit. And the last strategy that what I want to talk about today is the smart tax play, annuities for IRAs. And we just mentioned that we can move existing IRAs into fixed annuities, especially if the client's looking to preserve. Now, what we can also do is we can open up a brand new one, or we can continue contributions into the annuity that we just move money into. That way, your client can still take some income off of their tax liability every year. Now, we can use unmatched, or if 401k contributions, or if your client's maxed out on 401k contributions, we can put that into an annuity. Also, the money that's in the 401k, that also could be a future rollover opportunity. So even if you're getting that $5,000-$6,000 today, you've got the client on the books, and you know they've got an asset they're probably going to need to move at some point in the future. With the Secure Act, that's some legislature that came out in the last year. And when it comes to IRAs, the main point that you need to take away from it is that clients can actually still fund their IRA all the way to age 72. The IRS has given them a couple of extra years to work and fund money into their IRA account. And as far as contribution limits, it's $6,000 as of this tax year up to age 50 that they can put into an IRA and receive the deduction on. And if they're age 50 plus, it's up to $7,000. So again, if you're looking for a smart tax play, we know that annuities are tax deferred. We know that we can move money into annuities without creating a taxable situation for your client. And we can even use annuities to help take some tax liability off the books. And the solutions for the IRA strategies would be using a flexible premium FIA. I know Raul and I have identified for some, especially for startup IRAs, where they'll allow for that contribution to be put in every single year. So I know we talked a lot today about going through annuity basics, demystifying some of the myths, where they make sense as a safe money play versus where investments make sense as from the Wall Street play and the working years play. But you're going to want to get to Eagle School to dive into so much more. Now, one thing that we haven't talked about, just out of pure respect for time, is retirement income planning. This is the #1 reason annuities are used, in addition to as a savings alternative. We'll talk about, is my Social Security taxable? We'll go over what is protected lifetime income. We'll go over what's the MUG approach when it comes to calculating your client's income need. We'll talk about the 5 sources of income that your clients typically choose from. And we even talk about our personal pensions right for my client. One thing I like about this question is this is where we help show a client the benefits and get the commitment of adding an annuity to their portfolio without ever mentioning the word annuity. We talk strictly benefit and concept, and it makes all the sense in the world. And as Michael said, we'll also talk about reaching out to your existing client base and finding the best ways to spark up those conversations. We'll show you, how do you mine your existing database? How do I approach my clients for retirement services? What are key questions that I should be asking? How do I run a proper first appointment? What tax information could I leverage to your conversations? But most importantly, and Michael started off our conversation with this benefit, is how do I engage a team when I'm in uncharted territory? I'm sure many of you have had a client come into the office, or maybe, during networking or happy hour or family events, and someone says something that falls somewhere in the conversation of what we had today. And you thought, man, I wish I could answer that question. Or you know what? I think that's where an annuity might come into play, but I'm not quite sure. Instead of letting your uncertainty keep you from acting and engaging and putting yourself in a position to help that person, to help that client and make them better off, know that you've got a team, you've got a great quarterback in role to help you navigate that uncharted territory and earn some additional business that's going to take your brand and your practice to the next level. Raul, thanks so much for the time, man. Do we have any questions before I turn it back over to you?
Raul's muted there.
I don't think so. I think we're good. I think we're good as of now. But if anybody has a question, go ahead and shoot it. But gentlemen, I really do appreciate your time and your knowledge. Let me turn on the camera here. Awesome. And just kind of to piggyback and kind of close out our presentation for today, I really do think that there's a space where we shine. And I'll give you an example. I sat down with some clients yesterday and I was kind of going over their TSP. A TSP is very similar to a 401k. And the thing is that they were on the most conservative option because 15 years ago, they went aggressive and they lost like $9 grand. And the problem with middle America is that most of them don't have the discipline to lose money and just wait for it to come back. As soon as they start losing money, they get on the defensive and they're like, I'm out. I just can't handle this. So their TSP is on the most conservative option. In 2020, they made 0.97% interest on that TSP. So I was like, I can give you the same guarantees if you don't need the money right now, and I can put you somewhere where you can make between 5 and 6%. Easiest sell in the world, So it's just a matter of like Eric and Michael said, that there's a place for everything. I firmly believe there's a place for the stock market. There's a place for bonds at some point, probably not right now. There's a place for annuities, which is the space that we live in, and I think there's a lot of potential there.
And Raul, just out of curiosity, if you did one of those deals like you did with the TSP, if you did say one of those a month, in terms of revenue, what would that bring into a practice?
Oh man, depending on the size, but let's say it's just an average one. And if I did one of those a month, I don't know, maybe three or $4 grand in revenue, give or take.
So you're talking an extra $30,000-$40,000 a year kind of thing. You know what? If you want to do the six figures, you want to make an extra six figures, you know what? Do 2 a month. It sounds easy, right? But that's one of the things we're committed to bringing to Eagle School is kind of a systematic approach and kind of go through there. So I'd appreciate everybody giving Raul some feedback in terms of what you guys want to hear more about. Do we need to go more high level? Do we want to go more detailed? You know what I mean? Let the man know. He's the ultimate quarterback, so I'm going to put him on the spot and make him scramble a little bit here. But he'll help set us up right to make sure we're doing highest and best use to everybody. Raul, thanks for your time, buddy. I really appreciate it.
Thank you, guys. I appreciate your time. All right. Very good, guys. Well, I think that pretty much wraps up our presentation for today. Let me see here.
There's 2 more slides with your contact info on there.
Yeah, let me segue to that. Give me 1 second here. All right. I was following along. You guys can see my screen, right?
Mm-hmm.
All right. So like we mentioned earlier, guys, you have our contact information as far as the email, the live sales email. So you guys are always welcome to reach out to us there. You can go to our website. We have so many resources there just available to you. Get a basic understanding of all the different products and everything that we have for you. My personal information is here. So this is my personal number. This is my personal email. You guys are always welcome to text me or call me. Most of the time, if you call me and I don't have your number saved, I'm probably not going to answer. So leave me a message. And then a lot of the times, if you call me and I do have your number saved, I'm probably not going to answer because I'm either in a meeting or talking to clients or something. But I will get back to you. Always the best way to reach out to us is always via email, because I don't open my emails until I'm ready to work. on whatever the email is or whatever the content. So email is always the best. Don't forget our Eagle School. Don't forget to register for that. You guys have all the information. We're going to have more information coming to you via email. Tomorrow we have George. He's going to be talking about PNC, and I think that pretty much wraps up the day. Let me just verify with our team, see if there's anything else or if anybody else needs to jump on before we call it a day. I want to say that's it, but I'm just verifying with the team, guys. In the meantime, if any of you guys have any questions, please let us know. We're here for you for any questions you may have. Eric, I think we're good, man.
All right.
I'm gonna go ahead and wrap this up, but thank you so much for your time. And
Yeah,
then
of course.
I look forward to our live event. It's gonna be great.
I'll see you on Dallas.
Thank you, brother. Appreciate it.
Thank you.